Hello, everyone, and welcome to another episode of The Pragmatic Investor. My guest today is Mike Zaccardi. He is a fellow essay contributor, CFA and CMT, and a very prolific financial writer. His passion is putting a narrative on financial data. So that's exactly what we did today. We had a really long and in-depth conversation about market. We recorded this yesterday, just after the JOLTS number and after a significant rally in both stocks and crypto. So we had a lot to talk about. We covered the recent data with JOLTS, Mike's expectations for inflation, his general outlook on stocks. We talked a lot about the technical outlook for various indexes. I also got the chance to ask Mike what he thinks are the best investments right now, if he thinks we're going to have some sort of a market downturn in the near future, and what, in his view, are the most important data points to be looking at for the coming weeks and months to determine where markets are heading. Mike is incredibly knowledgeable, and it's always a pleasure talking to him. So, I really took this chance to ask him a lot of questions, left no stones unturned. We even discussed some specific stocks that Mike likes and really got into the weeds about how to manage a portfolio and find those great investment opportunities. If you'd like to follow Mike, you can do so on Seeking Alpha, and you can also check him out on Twitter/X at Mike Zaccardi. As always, I hope you enjoyed this conversation as much as I did. All right, Mike, thanks for coming on. Quite a wild day in markets. The NASDAQ is up about 1.8%, 2%. I can't even keep track of it. Bitcoin is up almost 7%, reaching that 28,000 level almost again. Obviously, there's a couple of big catalysts today, but I'd just like to get your take on it. What's going on today? What's moving markets?
Yeah, I mean, the big thing today was that JOLTS number, which came in super soft in terms of the demand for labor, job openings, the number of those coming way down. You look at the 3-month average now, the biggest drop on record, about 2.5 million job openings to the downside, which is great news because that means the Fed might be having its way with slowing down the pace of payroll growth, which is, of course, one of the key metrics they have for tightening financial conditions and cooling off the economy. So market like that today, but I think you got to take a step back a little bit too. I mean, last week we had the NVIDIA earnings release, which was kind of a dud, not in terms of the earnings they reported in their outlook, but in terms of the stock price reaction. So that kind of weighed on markets. I think there's a lot of hoopla going into that, and that came and went. And then we had Jackson Hole, which is kind of a Rorschach test in terms of how people interpreted his message. There was something for the Hawks and the Doves and the Bulls and the Bears. So we got past that. And so I think today, the data itself was soft, which the market wants to see right now. And I think the rally since this morning is definitely, it has hallmarks of kind of a relief rally after a tough month. The S&P 500 was at one point down about 6% or so for August, and now we're down just about 2%. So that's an encouraging sign as we go into what is typically the weakest month on the calendar for September. So a little bit of optimism going into that. But we got a long way to go between now and the end of the week. We got a bunch more employment data on the way. We'll get ADP tomorrow and the big report on Friday for the August job situation. Also get another look at second quarter GDP later this week. So it's a busy week, and we'll get M2 money supply coming out too. So for the last week of August is actually a really busy economic week that is going to set us up for September. And then you mentioned the Bitcoin news. The good ruling for spot Bitcoin ETFs, which now may open the door for any number of fund issuers to go ahead and mint their own product. So you saw Bitcoin trade up almost $2,000 on that, just shy of 28K right now, and ETH as well, getting past 1,700. Interestingly, I think Coinbase was up a bunch today, which is kind of weird because you would think if we're going to have all these spot crypto ETFs. It's like who would want to or need to go to Coinbase to trade it? But maybe that was a little bit of a short covering move there. And maybe kind of this was priced in at least for Coinbase shares. So that was kind of interesting. But yeah, a pretty active day in the market today. Rates down huge, tech stocks up. So kind of that old narrative.
Yeah, absolutely. Just when everyone's trying to get a week off on vacation, you get all this data, all this movement, and all this stuff happening. Yeah, like you mentioned, Coinbase up. I think some of that might have to do with the idea that I believe Coinbase is involved with BlackRock's ETFs. So I guess the idea there being that Coinbase can kind of benefit now that institutions are coming in. It's going to kind of be the bridge that a lot of these institutions are going to be using for to handle their ETFs and all these purchases. Now, it's interesting. I was actually looking back at the conversation we had a few months ago for the Investing Experts podcast, and you did mention back then, we were talking about the job situation and how you actually mentioned how probably towards the second half of the year, third quarter, we'd probably see that weakening. And in fact, we did get that with the JOLTS numbers. Obviously, market very happy that people are going to find it tougher to get a job. In terms of macro data, obviously we have a lot of stuff coming out. I was wondering what your take was on the PC. I think we have PC on Friday. What's your take on the inflation debate right now? Because obviously, we've got some interesting remarks from how, some people wondering whether we can get down to 2% as quick as possible. I think you look at stuff like the tips, they're pricing in a bit higher inflation in the last few weeks. Yeah, how do you see those PC numbers and the outlook for inflation?
Yeah, well, yeah, last week Powell kind of gave us a hint at kind of the July PC numbers. Now, it wasn't like a leak or anything like that, but he was generally sanguine on where inflation may be headed. So, yeah, I mean, I like to look at the markets for the best gauge on expectations with those things, and you look at tips yields and break evens going out the next couple of years, going out 5 and 10 years. I mean, they're pretty tame. The volatility in those is really low. We had a little spike up as oil prices rose earlier this summer with the break evens, but they're all suggesting that we're looking at 2.5% inflation over a number of periods. So it looks like we're on the right track. I do think it will be tough to get that incremental move to 2% from 3%. I think in the next few quarters, the wage growth numbers definitely have to retreat a little bit. But what could offset that potentially is a pickup in productivity. So, if we get continued productivity gains, which we saw for the previous quarter, that could support economic growth without it putting a whole lot of upside to inflation. So that would really be a Goldilocks kind of scenario and an indicator to watch. But yeah, I think like most people, I think that getting that extra half a percentage point or 1 percentage point down on PCE and CPI numbers is going to be tough. And if we're a year from now and we have core inflation running at 2.5, maybe the Fed at that time is kind of going to be okay with it, and they won't try and send the economy, dipping any further. So that'll be interesting. I think that could be the monetary policy theme of next year. Now that we should have the rate hike cycle done by November, so that'll be something to keep writers like me busy. I think next year talking on the macro front.
Absolutely. So you mentioned that rate hike by November. Is that your outlook right now? I think that's pretty much. I saw about 50% of the market is pricing in that by November we will, like, either this September meeting or by November at least, that we'll have at least one more rate hike. Is that kind of where you stand right now?
I mean, I don't have a real firm outlook on that. The market's pricing in about a 6 in 10 chance of a hike by the November 1st meeting. So it probably happens. The terminal rate is kind of held steady after a bump up last week. So it seems like the market's okay with that. So it may not really even matter that much whether we get it or not. The thing about those probability markets is, like any betting market with an outcome date, the nearer you get to that date, the more the market kind of decides on it, and the more the probability gravitates towards 0 or 1. So I think certainly after the September Fed meeting, and after we get a couple more CPI reports, we'll have a pretty good handle on what they're going to do. But you consider that the Fed has raised rates 15 plus times in the last couple of years now in terms of quarter point hikes. That extra one, I mean, it's just kind of a formality more than anything, I think.
Right. Yeah, of course, of course. Now, you were talking about the rally today, and you did use the term, I believe, kind of a relief rally. Is that what you're kind of seeing here? A kind of dead cat bounce? Are you seeing more immediate downside in the market?
Well, I mean, relief rally isn't a bad thing. Everyone's kind of waiting on this correction in the market, and folks like to look at 10%. But we had to move down almost 10% in smaller caps. The S&P held up better. So, I mean, I guess I would still kind of bias more to the downside here for the near term based on typical seasonal weakness. You look at a day like today, kind of going out on the highs of the day is pretty strong. I would say it has some hallmarks of a corrective move and a broader trend lower in the near term. So, yeah, I would say that if we do get a move lower, as if we approach that 10% mark, I see support in the market at about 4,200. So that'd be not a bad spot to buy the dip, so to speak. And that's also where the 200-day comes into play, thereabout. So, I guess I don't see a whole lot more downside, but given that we put in a peak there on July 31st and approaching September now, we could certainly see another move down. But I think that would be a move that should be bought.
Absolutely, like you said, September traditionally one of the weakest months, so definitely it's going to be interesting as the month is going to be starting in a couple of days. Now, of course, a lot of the latest macro news has revolved around the whole China story. Of course, we had Evergrande filing for bankruptcy, and the PBOC really kind of now showing some signs that it's really going to step in. Obviously, they believe the bank cut its benchmark rate a couple of weeks ago. More recently, there's been more talk of, they've been talking to banks about, kind of shoring up stocks. I believe yesterday there was an announcement that they were going to cut trading fees or something like that. So yeah, where do you stand on China? How do you fit that into the macro narrative, and especially how do you think it affects the US at this point?
Yeah, I mean, China's always big, but it's a lot different now than it was. Even 5 years ago. I mean, it used to be you would wake up in the morning, check what China's doing, and that would kind of dictate a little bit what our futures would look like. But that's not really the case anymore. The market seems to be fine with a soft China. I mean, you look back to earlier this year, there was so much optimism regarding China's reopening and the end of their zero COVID policy. And, there was a bump up in their market for a time, but they've been kind of going straight down since the spring. Meanwhile, our markets have been doing just fine. So I don't think it's a big of an impact. I think any incremental gain that we can get from, or at least any incremental encouragement from Xi Jinping and the China regulators would just be a bonus at this point, because everyone assumes that they are just, they have kind of this half-handed way of easing that doesn't really do anything. So it's really almost just a signal more than an actual policy shifts. You look at that, the trading, percentage cut earlier this week. I mean, that's just hardly anything. Right. And then the stimulus measures earlier this month with cutting rates was much weaker than people were hoping for. So, yeah, it's firmly entrenched that the Chinese government is no friend of business right now, even with these moves that, on the surface appear stimulative in nature, but they're not really doing anything to, ameliorate any of their issues with their economy. And maybe they don't want to. Maybe they want to keep kind of what they have and the power they can inflict in place. So that gets very much into a lot of geopolitical matters. But in terms of price action, China stocks always look like they're trying to put in a bottom, but then they always kind of end up rolling over. So the onus is on the bulls to carry FXI is the ETF I look at there to carry that higher. And we're just not seeing that too much right now.
Yeah, absolutely. I mean, Chinese stocks have burnt us a few times, and it's definitely investors are definitely a bit wary about getting back into those markets. Now, the other big international economy, which has also had quite of headlines surrounding it, is of course Japan, right? So we had the Bank of Japan kind of lifting that yield curve control, the yen really sliding, and there's been some talk of the idea that the yen carry trade could be becoming unwound. I don't know if you follow Michael Guyard. He's obviously also on Seeking Alpha, pretty vocal on Twitter, very fun follow. What are your thoughts on Japan? Is that something that could pose a risk to the rest of the economies as that yield curve control is unwinding? Any thoughts there?
Well, I think what Japan is doing, is interesting from the monetary policy perspective. But then you look at Japan stocks, and they're holding up pretty well, especially if you hedge out your yen exposure. The DXJ, the Japan Hedged Equity ETF, pretty much at multi-year highs here today. So, price action is working there. So, yeah, and the Bank of Japan was kind of almost in a way dictated what the Fed might do, because they went ahead and made their monetary policy change, kind of lifting their controls over their yield curve, allowing inflation to kick up, and that kind of forced the Fed's hand a little bit to have to be a little more hawkish from a global coordination perspective. So, it's always concerning when you see the yen come under so much pressure, as we've seen, in terms of what that can mean for money flows globally. But in terms of price action, you got to like what's going on in Japan. Some of the best performing stocks in the world this year are Japanese small caps and some other sectors in that country. So, price action wise, it looks pretty darn bullish over there in terms of the equities.
Absolutely, and I remember that's also something we mentioned last time, that at the end of the day, it's that price is obviously the best indicator, right? Because the price is where people's at. It kind of reflects what everyone's thinking. But to that extent, we are getting kind of a lot of signs. Obviously, China not doing very well with the real estate. Japan kind of struggling a bit. I mean, we've had other signs before, right? The UK at one point also had a lot of the UK bond market also had a lot of stress. I mean, yields not today, but they have been creeping up in the US, and that also kind of brings back the idea of could we see some kind of liquidity event? I mean, banks, for example, right? Regional banks, they were in trouble 2-3 months ago. Well, now yields are still at the same level. I mean, are they not in trouble anymore? And how is this, all this stuff going on abroad? Could that spark some kind of a liquidity event? Let's say some kind of a crash.
Well, I mean, a crash can happen any time. So, yeah, I mean, the answer is, of course, always yes to what could happen. But there's always headlines out there, and there's always reasons to be afraid of markets, and that's what creates your essentially your equity risk premium to be going into stocks. So yeah, I mean, there's going to be, chances are, if we have a continued correction, any one of those reasons could be cited as the primary driver of it. But a lot of those same issues have been known for quite a while. I mean, you look at the U.S. regional banks. We've known now for many months that that's not a great area. Same thing with U.S. commercial real estate, and what rising rates mean for all of that. So it's always a risk. But at the same time, you look at what stocks and the dollar have done. They're not exactly suggesting that these are cataclysmic events. So yeah, I mean, you can't help but draw the parallel to '87 in terms of some of the price action we saw this year so far. And the treasury market is very important for maintaining liquidity in the system, and a high level of interest rate volatility is a concern. You would like to see that come down a bit. I think it will once the Fed is kind of through with their hiking cycle. But yeah, it's a big risk, and equity market volatility is kind of not reflecting that. We see basically historically wide differences between the bond market volatility and stock market volatility, which is unusual, and it's hard to really pinpoint. I guess it's hard to kind of explain that away, and how long can we have some of these wild movements in the treasury market, which the market depends on for liquidity, just as stocks continue to kind of hover near these year-to-date highs. So yeah, it's a concern. And if we're going to see volatility, chances are it'll be between now and mid-October. I can say that.
Absolutely, yeah. And definitely, like you say, we could do that comparison with 1987. I think also a comparison maybe even to 2007, 2008. I mean, back then you had the Bear Stearns collapse, back then, and market rally after that, right? And kind of shrug that off. And then, of course, eventually we had the real shoe dropping. So, I do think there could be an argument to be made there. But like you say, there's always, right? A recession is always coming at some point, right? There's always going to be a crash, and someone's got to fill those headlines somehow.
Yeah, that's for
and
sure.
speaking of headlines, so I wanted to talk a little bit now about some specific sectors, gold, commodities. In terms of gold, we did get some interesting news, of course. Well, it's not exactly news, it's been known for a while, but we had the BRICS summit, I believe it was last week, and the talk of them launching this gold-backed currency. Any thoughts there on that gold-backed currency and the outlook for gold, and I guess also the dollar to that extent?
Yeah, well, I mean, I don't know about any kind of gold-backed currency. I think that the ship has kind of sailed on the heyday for gold, in terms of it being some kind of global standard. I don't think we're really going back there. But in terms of price action, the biggest determinant of where gold goes is real interest rates, and we've seen real rates climb big in the last, really just since mid-July, and gold has hung in there. It certainly fell off its highs, but you look at the performance relationship of real rates and gold, and it's been impressive, I think, to see gold hang above 1900. So, it's still an underperformer, though, on a relative basis versus so many things. So it's certainly a large opportunity cost to be owning a significant gold allocation. But should we see real rates kind of drop in a kind of a anti-inflation recession scenario with slower economic growth, that could certainly be the catalyst to take gold to new nominal highs. If we see a backup of a percentage point in the real 10-year, the yield, that could easily send gold up a few $100 within several month time frame. But I mean, it's really just kind of wavering under its highs. It's very unimpressive, unenthusiastic price action. Volatility is really not all that high in gold right now either. So yeah, it's not too exciting right now. And then in terms of the dollar, a really big move from mid-July. We were under 100, now near 104, although today was a really ugly day for the dollar after that JOLTS number. The dollar really tanked after that. But after peaking last September, it too is kind of just meandering. So, we're kind of seeing this with a lot of currencies outside of the yen, really kind of trendless action, which, stocks, I think, would definitely be happy with a sideways dollar in the near term after this big run up in the last 6 or 7 weeks. Especially when you look at the earnings picture. If the dollar hovers in the low 100s without too much volatility, that should kind of smooth out the earnings picture for the S&P 500. So yeah, after today's move in the dollar, I'll be interested to see if the bearish move today is kind of backed up later this week, especially after the jobs number. So maybe a key week for the dollar here in terms of a potential reversal back lower. We'll see. But definitely some interesting action intraday today.
Yeah, absolutely. And the dollar, I think, very important moving forward. We've seen it really kind of hold that very strong correlation with markets, and it's kind of determining, where it's going to go. So, higher dollar from here, I think definitely will send markets lower. But, if we can sustain that downtrend, then of course, blue skies ahead probably. Now, another commodity that has done a little bit better, at least in recent weeks, is oil. What's going on there?
Yeah, oil's had a nice run from the mid 60s up to the low 80s, and now it's kind of hanging out. Definitely an impressive move considering the move in the dollar as well,
Hmm.
and also in light of the fact that economic growth outlooks generally, I mean, the outlooks themselves have been not all that bad. We've seen pretty positive economic surprises lately. But the consensus is, of course, that we should see slowing growth in the second half, maybe troughing out in Q1 next year. So the move higher in oil is pretty impressive. Of course, we have the SPR at 40-year lows in terms of how much that's been filled, and then the global demand picture doesn't look all that great. Meanwhile, you have U.S. production very strong. So yeah, I think we got to break above this $83 level or so on oil to see some the next leg higher. Until then, we're kind of just in a kind of a wait and see mode with that. But be on the lookout for oil. If we do see that dollar dip back toward 100, that could be lift off for oil, which should certainly help the energy stocks and cyclicals out there as the second half progresses. So yeah, it's been an impressive move, I think, given all that's been happening at a macro level in the last couple of months to see oil recover like it has. So I'll definitely keep my eye on the 83 level on WTI to see if we can break out above there.
Hmm. Absolutely. And I also wanted to talk about agricultural commodities, right? And you actually wrote an article pretty recently, a couple of days ago, about a specific stock. How do you pronounce this? Bungie?
Oh yeah, Bungie. Yeah, that's always a fun one. I think they just got added to. Was it added to the S&P? It was in the news for being mixed up in the indexes.
Uh-huh.
Um, but yeah, my outlook on that is pretty bullish. You look at the valuation situation with them; it's looking pretty good, and they should benefit from some of the rising demand for renewable energy around the world,
Hmm.
and a lot of their operations and their processing and merchandising areas look pretty promising. And they had really strong earnings earlier this month, which helped out too. So yeah, Bungie is one I came out bullish on. The chart as well, which is always a key part of my analysis, looked pretty good. It got above a key level of resistance there around 107. So as long as we stay above there, we should be good. And it's coming up a period of almost a couple of years of consolidation. So keep an eye on 128, the prior high. If we get above that, it could be definitely blue skies ahead for Bungie.
Hmm. Just as a quick overview, what is the Bungie's business exactly? What do they do?
Yeah, so what they do, they're in the staples sector, agricultural products.
Hmm.
So it's kind of like a food business. They have operations around the world, like $60 billion in sales. So a big player. Food production, fertilizer to farmers, buying, handling, selling oil seeds, grains. So they kind of do a lot of that middle ground in the ag space. So they're not like maybe a direct producer of some of those things, but they support a lot of the operations to uh, get food service operations to customers and consumers.
Hmm. Of course. Now, since we're talking about single stocks right now, we also talked briefly before about NVIDIA, but I'd like to get a bit more of your thoughts on what you thought about the earnings and also what do you think about the chart? Because I mean, personally, I don't see it as a great chart right now, at least in that technical perspective. I thought the earnings left a bit to be desired. I was a bit baffled by that buyback, to be honest. I don't know. What were your thoughts?
Yeah, I mean, definitely blow out earnings once again. And then you look at today; it actually settled today at an all-time high on a
Hmm.
closing basis. And one of the principles of technical analysis is it's closing prices that matter. While those intraday reversals can look important, if you just focus on the closing prices, you tend to get better outcomes in terms of identifying and sticking with trends. So yeah,
Hmm.
it closed today at about 488, so within a stone's throw of the gap higher last week up in the low 500s. So yeah, we pulled back quite a bit, more than about 10%, which is certainly healthy. And then today you saw a pretty giant move in the stock price, worthy of about what, 4% on $1 trillion company, so $40 billion in market cap gain today. So to me, I think it's doing all the right things. It got maybe too frothy there heading into that earnings report. People were expecting big things, and they got it with the earnings, sales, earnings, and guidance. And then we pulled back. But now with today's rally, we're almost right back in new highs. So the dip buyers appear to have come out, and this stock shows no signs of wanting to ever fill that gap that we saw back in May. You know, a lot of novice traders and kind of casual technicians have this kind of idea that gaps on a price chart like always have to get filled, which is totally not the case. You know, gaps come in three varieties. You'll have a breakaway gap, a runaway gap, and an exhaustion gap. And if we consider the one in May a breakaway gap, I mean, that can go years or just never get filled, and that's totally fine. Whereas the gap last week was maybe a little more of a short-term exhaustion gap, and that got filled and some, and now we're just a few days later, right back to where that was. So to me, that's pretty encouraging. So yeah, I generally like the chart here. It's generally from bottom left to top right. So pretty good action there. And if this breaks out to new highs in the next couple of days, that would, to me, that'd be a very encouraging sign for encouraging sign for the broader market.
Absolutely. Like you said, the market has been in general led by those tech stocks, that AI narrative. Now, moving forward, though, given that we've had this big run up in tech, are there any other interesting sectors? What do you think? Is tech going to keep outperforming, or are we getting a bit more of a rotation to other sectors, commodities, cyclicals?
Well, earlier this year we had industrials performing really well. Energy has kind of come back in the last couple of months with oil prices rallying. But like you said, bigger picture, for all intents and purposes, it's discretionary comm services and technology that have been outperforming. Those are the only three sectors that are beating the S&P 500 so far this year. If you pull that back a few more months, you'll see some other sectors participating. So it's been a little more broad-based in a sense. In the last 3 months, energy is the top performing sector. That could surprise some folks. And you have some defensive areas like staples, utilities, the weakest areas in the market. So, to me, the sector situation is not exactly a screaming bear market or recession. I mean, you get discretionary and energy teaming up to lead the market higher in the last few months. That is a pretty encouraging thing. And then you get a lot of global multinational industrial companies outperforming too in that stretch this summer. So I wouldn't be surprised to see energy, kind of lead the way in the second half, keep leading the way in the second half, with a little bit of a baton toss from mega cap tech to some of those more risk-on cyclical areas, just based on recent price action. But anything can happen. And of course, with energy, anything resource dependence, moves in the dollar, and any kind of fears over economic growth, that could definitely send those sectors into a pretty quick correction. So, but gun to my head, I would still say energy industrials. I would rather be overweight those areas than big cap tech.
Absolutely. And if we do get a little bit of a sell-off correction, where's the place to hide? Can we start getting into bonds?
I think that's tough because we still see a positive correlation between stocks and bonds right now. So it's hard to kind of bottom pick, or at least take a stab at when the right day is to say that treasuries are all of a sudden going to become a really good diversifier. From a longer term perspective, I have no issues having a bond allocation now, because even if we see a continued rise in rates, the nature of duration and convexity means that a 1% move higher in rates today means a whole lot different than it did 2 years ago.
Mm.
So you can make up with income yield a decline in a bond's trading price quite easily. So I think bonds are probably fine longer term, but in the near term, we still see that positive correlation between treasuries and stocks right now. So I don't know if that would be really a great place to hide. It would probably take some really unforeseen event to cause a flight to safety kind of trading atmosphere out of stocks into treasuries. I mean, you look at today, for example. I mean, we saw stocks way up, bonds were way up. So we just continue to trade kind of like for like on stocks and bonds. So if we do see a move lower in stocks, you're more, I guess, cash flow heavy areas of the market may do well, and maybe stocks are still down a couple percent in the last month, and energy is still outperforming in that time. Maybe energy is kind of a good diversifier, just the energy equities themselves right now. So yeah, that's I would still keep an eye on like energy, healthcare. I think those are two sectors that may kind of buck a trend if we do see a move lower in the overall market.
Mm-hmm. Absolutely, and very good point there, as you mentioned, on how those bonds really the interest rates and kind of can easily compensate now at this point. And just to wrap up, moving on to like looking out towards the next 2, 3, 4 months, what kind of macro indicators are you most looking at? Let's say in terms of leading and showing you where things are going. What are you keeping an eye out for right now?
Yeah, so that's a good question because for so long now we've had the soft data, your manufacturing surveys
Mhm.
and consumer, pulses. Those have just been so in the gutter for so long now. Even the leading economic index that the Conference Board puts out, that's been terrible for so long. So some of those things that were once thought to kind of be harbingers of where the economy is heading, I mean, that's kind of been broken. And then, of course, labor market data, inflation data, a lot of that stuff is so backward looking. Even the JOLTS number this morning, I think it was like the June number for JOLTS. I mean, so it's so much in the rear view. To me, I think what you might want to look at are simply the actions of executives and what corporate body language is telling us. I write for a company called Wall Street Horizon, where what we do each week is we look at corporate event data and kind of parse through the noise, trying to figure out what companies are telling us without actually telling us, right? So we go through a lot of data to try and figure that out. One article that we worked on last week was looking at the number of splits, stock splits.
Mm-hmm.
So we analyzed the number of reverse splits versus traditional splits, and that's been very, very bearish this year, which actually kind of makes sense because so many companies, small companies have struggled, and it's been the large caps that have outperformed. But as we just wrapped up Q2 earnings season, but Q3 earnings season will begin in October, and getting a sense from executives and what they're seeing and some of their internal data at the consumer level. I mean, that's, I think, the best we can do right now, just because so many data points have proven to be false signals in the last few quarters. So it's tough. And being a technician, I always like to say price is the ultimate arbiter of these things. So pay attention to inner markets, what's going on between stocks, bonds, commodities, and currencies. What's going on among the 11 sectors. I think that in itself is going to tell you the most about the macro. So it is tough right now to kind of parse through all the noise, and so many relationships that had once worked now don't. But that's the nature of markets, and you always have to be open to changing correlations, and that's kind of the biggest skill, I think, to navigate the market right now.
Absolutely. Well, that's a great summary, and I think a great place to wrap this up. Before we log off, just let everyone know where they can find you on the internet.
Yeah, just follow me on Twitter, Mike Zaccardi. I'm not trying to sell anything. I'm not looking to get any subscribers, anything like that. Just you can follow me if you want. You can read my stuff on Seeking Alpha, but I just try and put my thoughts out there. And yeah, as a writer for as a freelance writer for a bunch of different clients, staying busy and just keep my eye on the markets at all times. That's for sure.
Absolutely. Well, there you have it. Do yourself a favor, follow Mike on Twitter. I know I do. And Mike, as always, it's such a pleasure to have you on. Always really interesting to get your takes on the market. And, I hope we can do this again sometime.
All right. You bet, James. Thank you.
All right. Thanks again. Bye-bye.
Yep. Bye.
Thank you so much for listening to this episode of The Pragmatic Investor. If you enjoyed this Thank you so much for listening to this episode of The Pragmatic Investor. If you enjoyed this conversation, be sure to follow me on Spotify or YouTube. And if you'd like to get more of my content on investing, different trade ideas, weekly videos, and newsletter updates, you can follow me on Seeking Alpha or also on Substack. Plenty of free weekly content out there, so be sure to subscribe and don't miss out. You can find me on Substack, The Pragmatic Investor, James Ford, and also on Seeking Alpha.